Hello, this is Bryce Knorr, Senior Editor of Farm Futures Magazine, and welcome to The Buzz for Wednesday, October 31st, 2012. While Hurricane Sandy and Tuesday's election are at the top of the news cycle, grain traders are already looking ahead to November 9th. That's when USDA releases its latest production, supply, and demand report. I've got the Farm Futures estimates, along with what they could mean for prices. For corn, I think USDA will ultimately cut its forecasted production by around 275 million bushels due to a combination of lower acreage and yields. All of that reduction may not come in November, but the agency has a recent track record of cuts in the month. The last 6 November estimates have been lower than October by an average of 139 million bushels. Data from the Farm Service Agency's acreage certification program supports a cut, as did the final crop ratings out in November. But lower production may not lead to lower carryout. First, exports have been slow, which likely will cause USDA to lower its forecast for the marketing year. While the government doesn't like to make adjustments to feed usage before quarterly stocks data is available, I think they'd go ahead and lop some of the demand off the livestock category to keep ending stocks from getting any tighter. In the end, carryout could go up 20 million bushels or so to 640 million. After flat trade during October, the market is ready for a post-harvest rally unless the production number is bearish. Prices are rising around the world as our competitors run out of inventory, which should firm demand here in the U.S. How far and how fast the market rally depends on the flow of outside money. If investors fear a fallout from the approaching fiscal cliff after the election, funds could stay on the sidelines. South American weather will play into the scenario too. Flooding could reduce production in Argentina. With some locals, they are talking about a 20% cut. Strengthening bases should make storage attractive, but producers need to have a clear grasp on how much they can risk. With the average December futures price in October around $7.50, I recommend getting at least that much locked in on the board with unpriced inventory. Running trailing stop on a hedge to arrive contract seems prudent. Then transfer the risks to the options market where the downside is fixed. Soybeans could also see a mixed message from the USDA report. While USDA has cut its production estimate in 4 out of the last 5 years in November, the FSA acreage data suggests the crop could actually be a little bigger, say around 13 million bushels. But strong demand should more than make up for that small of an increase. I see both crush and exports running better than USDA forecasts, cutting carryout by 10 million bushels to 120 million. Seasonal trends suggest a rally into the November report is possible. 2 other factors could decide whether the market has legs for the rest of the month. The first is South American weather. Wet conditions are delaying planting in southern Brazil, and more rain in Argentina could slow the pace there too. However, showers will benefit dry areas to the north in Brazil, keeping a big crop possible. But any hint of a return of problems could kick a rally into high gear. The other consideration is demand, specifically from China. Negative crush margins and signs China was switching sales to other destinations could be an indication that buyers are starting to back off. But if China keeps buying 10 million bushels or more on a regular basis, that demand still looks very solid. China has aggressively shipped out its previous purchases, and there was even talk this week that the crop there was smaller as well. A rally in beans is more likely than not by the end of the year, but growers should be ready to sell pops as they come. Don't hold all your inventory for a run to $17 unless you can afford to roll the dice. Next week's report for wheat may not show a whole lot of changes. Carryout could go up 25 to 30 million bushels due to weaker exports, and global production should also be lower due to deteriorating conditions in Australia and Argentina. Still, wheat remains locked into its trading ranges, and it may not be old crop that finally yanks the market higher. The season's first crop ratings for winter wheat showed poor conditions as expected, on the northern half of the growing region. Almost half the crop in Nebraska and 61% of the fields in South Dakota were rated poor or very poor after lingering effects of the drought hurt emergence. Montana, Colorado, and parts of Kansas are also stressed. Still, the nationwide ratings aren't that different from last year, suggesting normal yields of about 46.7 bushels per acre for a crop of 1.648 billion bushels, only 22 million less than 2012. However, just looking at the state yield suggests less potential. The yield calculated that way is only 43 bushels per acre, cutting production by 132 million bushels. Concerns about hard red winter wheat on the plains could be the driving force of rallies into winter, but it may take time for those concerns to materialize fully. In the meantime, the country faces an election, the fallout from Sandy, and the fiscal cliff. All of these factors could make for very nervous markets at the end of the year that keep that outside money on the sidelines, making it hard for commodities to rally. We'll know more next Friday after the election and the USD report. I'll be back then with all the details on the next edition of The Buzz.